After a pandemic decline, consumer insolvencies are now on the rise. A new study from Michalos Associates finds half the insolvency claims filed in Canada last year were by millennials. It's the only age group that saw an increase in its debt load. For more, let's bring in Doug Hoyes. He's co-founder of Michalos and Associates. Doug, thank you very much for joining us. Tell us what the survey has found. And we'll just remind viewers that millennials at this point are people between 23 years old and 38 years old.
You're right, Paul. And what we found is that millennials are now the biggest cohort of people filing insolvencies. And the reasons are pretty easy to understand. Millennials, as you say, they're in their late 20s, 30s, early 40s, and they are starting off their life, unlike the boomers and the Gen Xers, with a lot of student loan debt. And when you're starting off in the hole, it makes it difficult to buy a house, get married, have kids. And so you end up resorting to things like credit cards to make ends meet, high cost loans. And then when the pandemic hits and you're working in a service job and you're laid off and end up taking things like CERB and CRB, you end up now with a bunch of tax debt. So it's kind of the perfect storm of a bunch of factors happening that have led to a massive increase in insolvencies for millennials.
So how much of an uptick in insolvency filings have we seen in that age group?
Quite a significant amount. And obviously, you can't compare the same person to 20 years ago because they weren't old enough. But when you look at the adult population, 27% of the population are millennials, and yet half of them are filing insolvencies. That's 1.7 times more than baby boomers, 1.4 times more than Gen Xers. So they're certainly on the uptick right now.
Your survey has also concluded that there is what you refer to as an alarming trend in the growth of rapid high-cost loans. These are largely payday loans coming from that segment of the Canadian financial sector, the payday loan business. Talk to us about that.
Yes, and in fact, it's more than just payday loans, because a payday loan used to be something where I borrow money, $500, I pay it back next payday. But now all of the payday loan companies and a lot of finance companies are now loaning what we call rapid high-cost loans. It's just a term we've made up, but they're more than payday loans. They're installment loans, and they can carry interest rates from 30, 40, 50, all the way up to just under 60%, which is the criminal code limit. And what we're finding is that more and more people are resorting to these high-cost types of loans. So, in fact, more than half of the people who file insolvencies, I'm not talking just millennials, I'm talking everybody, has at least one of these high-cost loans. And if they have one of these loans, it's very common to have more of them, like 4 of them. And the amount that they owe on these loans is now up over $12,000. So it's contributing to obviously a significant cash flow pressure. We're finding that overall people don't have as much debt that they had in the past, but the debt they have with these high cost rapid loans has a much higher interest rate, makes it much harder to service, and that's why they're much more likely to resort to insolvency. And
the rate on those loans, you've said it already, but I think it bears underscoring, the rate on those loans is between a 100th of a percentage point south of 30% to a 100th of a percentage point south of 60%. It's not legal in Canada to charge somebody 60% on a loan, but it is legal to charge them 59.99% on a loan. And some of these high-cost loans are priced that way, correct?
It's very common to see a 45% interest rate. Very common. That's not unusual at all. And then when you add in some of the service charges, there's an NSF fee, there's an over-limit fee, whatever, it's very easy to get very close to that 60% limit. And remember, these are rates that have been there for a year or 2 or 3, even during our extremely low interest rate environment. As interest rates have gone up a bit, they're still extremely high. So yeah, these are very high interest loans, but people are getting them because they perceive that they have no other option. They got to make ends meet, and that's why they're resorting to them.
What's your advice to somebody who can't make ends meet and is in perhaps desperation looking at some of those high-cost loans? What should people be doing when they get to the point where they're contemplating taking out a stopgap loan priced at 45%?
The only time a loan like that makes sense is if things are going to get better really quickly. I'm starting a new job in 2 weeks and I'm going to be doubling my pay, or I'm going to be inheriting a bunch of money, then fine, okay, I guess maybe it makes sense. But otherwise, you got to look at ways to fix it yourself. Can I get a part-time job? Can I get an extra job? Can I cut my expenses? And if I can't, and if the reason is I've just got so much debt I can't make a go of it, then you've got to deal with the debt. That's why obviously people are talking to licensed insolvency trustees about things like a consumer proposal to officially wipe out the debt. And that's why we're seeing the increase in consumer proposals that we're seeing today.
And let's finish with that. Just remind us what a consumer proposal is and what are the consequences to a person's credit rating, a relatively young person, a millennial. What is the consequences on their credit rating from a filing for insolvency?
If someone comes in to see us contemplating a consumer proposal, their credit score is already low. It's already damaged. So what this is a way to do is eliminate the debt. A consumer proposal is a deal. It has to be filed through a licensed insolvency trustee. It's regulated by the federal government. So those guys on Facebook who are promising to settle your debt, well, that's not a real thing. It's filed by a licensed insolvency trustee. In most cases, you're paying back less than the full amount owed. There's no further interest. There will be a note on your credit report that will say you filed a consumer proposal, but the debt is eliminated, and as a result, you can start to rebuild. So if you're a millennial now, cleaning up the debt now means that 5 years from now, 10 years from now, your situation will be a lot better, and that's why it's a preferred option for a lot of people.